In our videos over the weekend, we talked about that potential butterfly in this SPY, right? And that was around the 326.84 area, which is the half back zone. Over the weekend, we gapped down and we continued to make a move straight below our 327 area. If you did get a chance to enter that butterfly is currently trading for $1.17, and we were looking at it, it was 70 cents. So that's right around a 67% gain if you did get the chance to enter that butterfly. Now, if you didn't, there were still some other trades that set up today, which we'll talk about in this video. So I'll start by looking at a chart of the S&P futures, and we'll look at a 3-minute chart. Now, the interesting thing to point out here is during our 7 a.m. test, the S&P, along with the other two major indices, the Dow and the Nasdaq futures, had all broken outside of our conservative volatility box, and we were seeing price action that was going outside of the clouds consistently. Right? This is the S&P chart. This was the case of the Nasdaq chart, and this was the case of the Dow chart. So a very similar pattern across the board. Really, we knew within that first 30 minutes before we have any capital at risk that we should expect a greater than usual volatility day, especially on our conservative models, and that gives us a few choices. One, we can continue to look at each of these markets if we're trying to be aggressive and you prefer trading only the indices, but at this point you're layering on a second confirmation signal in the edge signals, and you're looking for an entry usually at the entry price, that cyan entry price or better, right? And that's in the case of the indices. Now, the one time we break that rule is in the case of gold, right? Where we sometimes we've talked about this, have to pay a premium, but the edge signals on their own have proven to be very effective on the gold futures market with, I think, a P&L of over 5K over the past 30 days. And we've sent some of you that backtest report, which you can reference. But the whole idea is that gold is a better oversold, overbought market, and those same signals aren't as effective without the edge zones in the volatility box on the S&P futures, the Nasdaq, and the Dow. Right? So you have two choices. One is you can be a bit more aggressive on these markets, but the second is you can focus on markets where you're experiencing less volatility than usual compared to these markets. Some of those examples today included the Russell. So if you look at that first hour test in the Russell, you can see that price actually stayed well inside of our conservative volatility box. And if we load in the aggressive volatility box here, you'll notice that it also stayed inside of our aggressive volatility box in the morning. Now, the fact that the S&P, the Nasdaq, and the Dow are all outside of their conservative box could be your hint if you'd like to be a little bit more conservative to be on the conservative box, but that would have then led to you missing some of these trades, but also would have led to you not having some of these stop outs later in the day, right after 10 a.m. So there's trade-offs there. But it's essentially, if you're using clues and you're trying to just be a little bit more cautious, then the conservative volatility box is what you are on for most of these markets. Now, if we go to the gold futures, you see something similar, which is the conservative box does a much better job of capturing the volatility in the gold futures. If we go to the bonds and we start with that same morning test, and here we can also load in our aggressive box, and you'll see that the bonds are captured even inside of our aggressive volatility box. So all of these are pretty stark differences compared to the indices, right? And they give you an alternative option of where you can go looking for potential trades. And finally, our last market was copper. Right, and copper on our aggressive box, you can see even in that first hour, copper was trading pretty much sideways for the most part, well inside of our aggressive volatility box lines. Right, so these are the places where you can start to look at potential trades, start to look at potential breaches of edge zones, start to look at volatility boxes. You could use the edge signals as your potential confirmation signal if you haven't typically traded these markets. Right, that helps you get the extra confidence that you may be looking for in these moves. So an example of that on copper, for example, is when you breach our volatility box here, the short that sets up, you're waiting for an edge signal to populate before you enter the trade at the cyan line or better with the stop outside of the volatility box clouds. And that then allows you to participate using the same levels, but this time on the move down, right? And this is a repeated theme that we've talked about, but those are your two options on days like today. One is be a little bit more aggressive on these indice markets, but you're on the conservative box and you've layered on another confirmation signal. Or two is you can focus your attention on these markets where that volatility is more controlled. You have an easier time trading. There's less competition as well and less eyeballs, which makes some of our setups more likely to work compared to the indice markets. All right, let's see what kind of activity holds for Tuesday and onwards in this week, and we'll see you in the next update. Take care, everyone, and good luck trading.